Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Karl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Kromendijk of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. Welcome to today's podcast. This is Nathan Merrill of the law firm Goodspeed Merrill, and today our Expert Network team is Sans Jeff Kromendijk of Security First Security First Insurance. Thank you. But we've got Karl Frank of A&I Financial and Mike Miller of Miller and Associates CPAs. And today our topic du jour is going to be retirement income. And I think we have some interesting facets of retirement income to address today, not just the how much should we consider and when, but how does it interplay, how do different types of asset classes, retirement accounts, after-tax accounts, Social Security, the different things we look to for retirement income how do they all work together? How can we maximize those? So full disclaimer, I think the bulk of today's answers are going to come from Karl.
I'm here for you, buddy.
But Mike and I have already brainstormed a number of questions that we think will be of interest to folks. Mike and I both acknowledged as we started planning out today's conversation that one of the first questions we get or that we field in the area of retirement income is how much?
Right. How much income?
How much do I need? What tools or how do you approach as a financial advisor? Because we always say, go talk to your financial advisor, right, Mike?
And then what happens after that, right? Yeah, what do you do? I think that's a great question. It's really common. What do I need to bring to a financial planner, and what's that experience going to be like? It's a really important one. Well, at our firm, we start with a discovery meeting. It's an hour and 15 minutes usually, and we ask a bunch of good questions. But we do want you to bring in all your financial statements, including tax returns and Social Security, because it all matters in retirement. And the process of figuring out what's your number, what's your asset number is a lot more than just math. There's a whole lot of things that go into figuring out what's right for you. And you want to know, we want to know what the money means to you, right? What are your goals and values and relationships? Where do you want it to be used, and how do you want to live in alignment with your money? So we'll start with that, and then we'll do the math, and we'll come back to you with a meeting, and we might need a whole lot more information.
Because it's going to be a totally different number whether you want to be jet setting or if you want to retire to that kind of cottage in the outer perimeter of Denver or something like that.
Exactly. I mean, if you're going off the grid, it's a completely different number than it is if you're going to stay and live in Denver Metro, right? And the examples you just mentioned, if you're going to go travel and spend and have a lifestyle of independence, and you call it jet setting, but even if it's not, the $1 million a year expenditures that you're talking about, there's a completely different thing, right? And for a lot of people, it's, I want to live for myself, but I also want to leave something for my kids or my church or my charities, And so it's a balancing act, and that's where we come from, right? We start at that level, and then from there we come up with the math. And that's a big difference. And, the rule of thumb that a listener could take away from this conversation is whatever the assets are that you have, divide it by 25. That 4% rule is approximately what you could pull out. And that's just a rule of thumb, back of the envelope. You're sitting on a jet plane board with nothing else to do. Figure out, okay, that's what I've got. That's about what I can pull out. And then you want to grow that number every single year. And so if you're invested in investments that will outpace inflation, you can reliably assume that you can pull out 4% of that in excess of inflation and maintain that as a lifestyle number for the rest of your life. The real details are a lot more complicated than that. We'll talk about some of those fun things next.
Well, let me just ping you on a couple of, because obviously what you do in retirement depends a lot on what you're doing now. So just kind of not a unique asset, but a specific asset that is common to most people is things like your home and your cars. What type of advice or counsel do you give folks when it comes to the size and duration of a mortgage or debt they're taking on as they approach retirement?
That is a great question. One of the big things that folks really want to think about is whether they want a mortgage in retirement. It's, it used to be that the 30-year mortgage, the myth was when the boys came back from World War II, we invented the 30-year mortgage because they'd work 30 years, retire, have their home paid for, and live at home off the pension from the big company like GM or whoever it was. Of course, the pensions went away and the mortgages stayed, and now there are mortgages that go out to 50 years in length. You may want to keep a mortgage for the rest of your life, especially if you want to move homes and you want to move into a home that you can live in the rest of your life. A ranch home is a good example, or a patio home, or one of the communities where you can, stay in place and they give you the care, they bring the care to you. Boy, that can be expensive. And so for some people, they need to keep the mortgages in place in order to have the lifestyle that they want later in life.
And as long as, from a financial planning standpoint, as long as that house is in a market like Denver where it's growing at, presumably
astronomically unbelievable, unsustainable rates. Yeah, seriously, right? Yeah, and Mike, as you know, you might want to pipe in. Tell me about the tax breaks. It can be a good idea to keep a mortgage.
Sure. Well, it depends. Right now, you get your standard deduction if you're a married filing joint couple is $25,800, right? $25,800. So if your mortgage is, you've got 5-10 years left on it, you may not have enough mortgage interest and taxes and donations to meet that. So it's going to depend on that side of it. From the investment side, if you sell the house, live in it 2 out of 5 years, and you can pocket the $500,000 gain and not have to pay any taxes on it. That's a good benefit.
It is, isn't it?
Especially if you're going to move, house to house. Maybe you want to go from a 2-story to a ranch, per your comment below. You may want to do that. You definitely want to take a look at the value of your home versus what you bought it for, and see, are we approaching that $500,000?
Yeah, that's huge.
Or $250,000 if you're single, right? So we can avoid some taxation on that and get our new home that we want.
That is one. I'd say that one right there is one of the unforeseen potential pitfalls of folks who are responsible and have bought a single home and stayed in it because they liked the size of their mortgage, their house was adequate for their needs, that sort of thing, is the fact that since they haven't constantly reset their basis in the home, they could find themselves having to pay capital gains when they sell and downsize. So,
especially in a market like here right now.
Yeah.
Where it's booming.
Yeah.
So to your point, Mike, this could be some of the unintended consequences of that particular tax is once people start approaching that $500,000 capital gain exclusion, they now have almost an incentive to sell their home and reset their basis and start fresh.
I love that idea. And another, related point to that is the timing of the year you have a big windfall, like a home sale, if it's going to be a taxable event, can really affect your future taxable income. For example, Medicare. A lot of people don't know that if you sell or have a big windfall in the years right before in the years that you're taking Medicare, you've got 2 more years of higher Medicare payments because the IRS is going to look back 2 years to your income and say, oh, look, you're rich. We're going to charge you more for your Medicare. And it's 2-year look back, so you got 2 years of higher Medicare payments. It's just kind of a salt in the wound.
Is that even if there's if it's excluded income, or is that only if it's above the exclusion?
Yeah, in a home sale, it would be above that $500,000 for a married couple or $250,000 exclusion. In Colorado, a lot of people have that.
Right. That could still be a couple $100,000 depending on the home. Yeah.
Oh yeah, and what if you're selling your business, right? Or what if
Right.
you're selling the family farm? Or what if you have an inheritance that's a taxable event?
No, it's not. 500,000 isn't exactly the magical number. That's what's in the IRS tax regs. But you got to pay salesman or the realtor commissions as well. So
Right.
that factors
Right.
into the cost of the whole transaction. So you could sell it for $540,000 above your basis and still
And have it net out.
paying taxes.
Right.
Isn't that a good idea though, to really calculate your basis and keep track of that over the years? How come they didn't tell us that when we bought our first home, right? All those little improvements.
depends on when you bought that first home. It used to be a rollover provision, and I don't know when the.
Man, that went back in,
sorry.
back in the 80s.
You're too young for that.
Dating ourselves on that one, but yeah, it used to be you bought the house, and if you rolled all the
Section 121, I think.
Yeah, if you rolled the old provisions of the sale of your home into the new one, you didn't have any taxation. Now it's
The reason I know that, Carl, is because I actually have clients, older clients, that come to me asking about now I can just roll this over to my new house, right? I'm like, not anymore. Yeah.
We'll let you off the hook.
No
on that.
grandfather there in that. No literal grandfather in that grandfather provision, but
Right. So home sales and big taxable events, they can hurt you in ways you don't even think about.
and just the cash flow planning that comes into play. I mean, just the home is that kind of asset that almost drives everything. You have to have shelter.
It really is.
Yep.
It's very true.
And I mentioned the cars. I suppose that these days that's not a significant.
Yeah, I think cars are a big deal, actually. I mean, how many do you need and how many do you want? And when are you going to sell them and what are you going to get for the new car that you're going to buy? And, the world right now is electrifying really quickly. And so I think, it might be by the end of our retirement that all of us are driving electric cars. Who knows,
Not me.
right? So you might not. You might not. But not all of us are going to be drilling for oil on our ranch, right?
Yes.
Nate might be, but the rest of us
That's
might
a
not.
great idea.
I think I like it too. Ranchers, where I came from, ranchers was just a code name for oil men, but I digress. The real deal is that, you're going to have these expenditures later in life that you might not otherwise plan for. And so that's something we use in our tools. We add events and they're wants and wishes, and we can integrate all of that and say, okay, so every 5 years you want a new car and you think it's going to be this, and we'll inflate it at that price so at some future rate it's a big number. And how does that screw up your plan, or how does it not screw up your plan? How much room do you have? That's all part of what we do, and that's something everybody needs to think about. If you're going to start selling stuff, what are you going to do with it, right? And how much taxation is that going to be?
Yep. So, moving forward through the retirement income discussion, we identified that there's different sources of retirement income, and they interact with each other differently. I think I kind of led into our episode intro with this. So we have taxable accounts, which are like your brokerage accounts,
Right.
just for
Any
clarification.
investment account, if you made any interest on checking and savings, which you don't, of course, in today's low interest rate world, that would be a taxable account.
Anything you invest with Carl, obviously, is in a
No.
it could be. So a taxable account. So then we have the non-taxable accounts, the IRAs, which
Yeah.
are divided into two classes:
Right.
your Roth and your traditional.
Exactly.
So it could be 401k,
tax-deferred
but-
accounts, tax-deferred retirement accounts are the vast majority of them. And then there are also tax-free accounts, like a Roth.
Right, like a Roth. And then we have Social Security income, which
Mm-hmm.
is the money we've stashed away with the trust fund back in Washington, D.C. that comes back to us magically. So we won't explain how that all happens because it's just a big Ponzi scheme. But I'm a little facetious when I say that. But one of the serious concerns about Social Security, and Mike, you brought this up, is how sustainable, how viable is it? Should we plan to rely on Social Security income? Or when you meet with folks, Carl, are you basically saying this is what we anticipate Social Security will be, but we want to make sure you're independent of Social Security if you can be, right?
Oh, I love that. Yeah, no, that's a really good point. And it varies. That's why we start with the discovery meeting, because every family might have a different opinion, and they might be, I want to plan without Social Security and just be safe, assuming that I'm not getting anything from Uncle Sam, or they're going to reduce my benefits. And so we accommodate that. But no, I mean, if you don't have that prejudice, if you don't think that way, then yeah, absolutely we plan with the Social Security, because even a little bit of fixed income from the government provides you a lot more stability later in life. And we've paid into Social Security, all of us who are paying into Social Security, for all of our working years. And so, even my most wealthy clients want to get their fair share out of the Social Security system, even if they don't need this money. It's a matter of pride, and we get kind of emotional about it. We're like, hey, I really want this. And so our conversations start at the beginning. Should I take Social Security early? Should I take it at my full retirement age? Or should I wait until age 70 when I get all of the maximum benefits that I could? And that's part of what a person needs to consider.
So,
And probably part of that is when you look at like life expectancy, right? So look, I'll get on my soapbox for a minute, and I look at it and I go, to your point, we've all contributed to Social Security, and I started working when I was 14, so I've been putting money in since I was pushing the broom at Woolworth and Woolco, dating myself there, right? So I've been putting in since then, and I look at it and I go, geez, if my life expectancy You know, if I'm going to pass away at 75, and I've put all this money into Social Security, I'm not going to get everything I put into it back out, right? So should I take Social Security out when I'm 65? Just on the guessing that I'm not going to live past 75. I mean, that's the game a lot of my clients ask.
Isn't it?
When do I start taking this stuff out?
Right.
Based on my life expectancy. When my parents passed away when they were 72 and 73, and their parents passed away when they were 68 and 70, and I don't think I'm going to live into past 75. When do I take?
Every one of those decisions is unique to the person.
You need to start running marathons. That'll kill you right there.
That'll make me live longer.
Supposedly, but apparently you don't feel that way.
So says Nate Merrill with the Dr. Pepper in hand.
Amen, brother. We all remember George Burns, though. When did he die? Smoked a couple of cigars a day. No, yeah.
Not a young man.
He hit 100, didn't he?
I think he did.
He was old.
He was not a young man. Yeah, and you make a great point. And so one of the calculations we do that makes it real visual for folks is a Social Security crossover date. So if you took it early versus taking it at the latest date or any year that you're planning on date, how long do I have to live before I get more income by waiting on my Social Security? Because every year I wait, it goes up by 8% per year for the rest of my life. So there's a real incentive to wait if you're going to go from $2,000 a month to $4,000 a month by waiting 8 years. That's a big deal. But for a lot of people who think they might be dying early, yeah, they make the decision to take it early, and they permanently reduce the benefit that could be. They might be betting on that later in life they won't regret it, and that could be the case. Or they might just be saying, there's no longevity in my family, or I've got a health condition, and I just want to get the money out early. And so that is absolutely an individual by individual decision, and it could be different for the husband than it is for the wife.
So let's talk about one of those other things that factors into the decision to pull Social Security, and a lot of people may understand this or may not, which is that Social Security at some level could be taxable income.
How unfair is that? It's one of the things that just rubs salt in my wounds. Yeah, it's called provisional income. They're going to take all your taxable income and they're going to run it, once you get into retirement, you start your Social Security, they're going to run it through yet another tax grid. And if you're a single person and you have taxable income of over $25,000 a year, you're going to pay 50% tax. And if it's over $32,000 a year, you're going to pay an 85% of your income or your Social Security income is going to be taxable. And for married people, it's pretty close to the same numbers, except it's only $44,000, so it's not even double. There's another marriage penalty for you. So yeah, it really stinks. So you're going to pay income tax on the Social Security, which is the benefit of the taxes you've paid the whole time you've been working.
So
imagine that.
To put a couple examples out there, so if the only income you had in retirement was Social Security, you'd pay no taxes.
Yeah, that's right. That's exactly right.
So if you had investments that were driving income in the form of dividends and maybe some interest, and it didn't exceed that $44,000 number, and you had Social Security benefits, you wouldn't pay any taxes.
Yeah, $44,000 is 85% taxable. For a married couple, you still have 50% tax at $32,000.
$32,000. Yeah. So there's some mathematical calculation to say, if my investments earned this much and I got this much in Social Security, I wouldn't pay any taxes.
But it's 50% over that number, not 50% from $1.
Yeah, it's 50%. No, it's 50%. It's
of
50% of your Social Security. Yeah, as soon as you hit $32,001, 50% of your Social Security income is taxable. As soon as you hit $44,001, 85% of your Social Security is taxable.
So how would this factor into a financial plan evaluation?
Oh, it factors in many, many ways. So you want to obviously minimize taxes every chance you get. So one of the things we do, and we haven't talked about it yet, but we should, and maybe we just dive into it right now, are the required distributions. So if you have a retirement plan, or if you have an IRA in which you put tax-deferred money, and you've gotten a tax deduction, and you put pre-tax dollars in, once you get to age 72 now, it used to be age 70 and a half until about a year and a half ago, now it's age 72, now you have to pull money out according to the government schedule. And a lot of people know this, especially people who are 72. They're like, holy cow. And in 2020, because of COVID, they postponed those payments. So now we're reaching the end of 2021 while we're recording this, and people are like, holy cow. A&I Financial's grown my accounts a lot. My required distribution is much bigger than I thought it would be. I remember it being really small. My account's 50% larger, and now I've got a really big tax bill due. Well, that's going to come in, and that's going to hit that provisional income right away. And so that in and of itself might force you to pay Social Security tax too. So not only, right, I guess you just got to look a gift horse in the mouth and say, okay, all right, I'm not going to complain too much. My accounts have grown a lot. I've got a little bit of income that I didn't have before.
So, and I think we've talked about this in the past, but just to kind of weave it in here briefly into this discussion, starting at 72 and a half or whatever the age is, you can also do that charitable contribution thing, can't you? Where
That's right. So that's exactly right. So it's a qualified charitable distribution called a QCD. And so if you're a charitably inclined person, you can just donate money right out of your IRA directly to a charity. It can't go to a donor advised fund. It has to go to the charity.
But you get a tax deduction or you don't?
You don't.
You just don't have to include it in income, therefore getting that haircut.
The RMD, it
Yeah.
qualifies as a distribution for your RMD.
And isn't taxable
Right.
based on this. So you get the full value, essentially, the full warm fuzzies that come from giving that money
you get
away,
all the
rather than
benefits.
having half of it go to the government and then being able to give half away.
Wouldn't that stink?
Yeah.
Yeah. No, it's a qualified charitable distribution is a great way to go.
For people who have income from other available resources, basically.
Yeah, if you're not living off your required minimum distribution, if you don't need that money, if you're donating already, look at the qualified charitable distribution as a way to give every dollar that you see in your account will actually be received by the charity, who is a tax-exempt entity and can spend every dollar of it and doesn't have to worry about paying income.
And going
tax
back
on
to
the
Mike's
receipt.
prior conversation, a lot of times in retirement, you don't find yourself elevating to be able to itemize anyway.
Right.
So with these larger standard deductions, if you can give and still get the
So
large
benefit.
yeah.
Save you a lot in taxes.
It's a great point, Mike. And if we do a good job for you in your retirement plan, we want to get you in those lower tax brackets where you don't need to itemize to try and save taxes. If we can get you that same lifestyle and maybe get you some money out of your Roth IRAs, which are tax-free, and other investments where there's tax advantages to your income, you can enjoy the same lifestyle and pay a whole lot less taxes in retirement. The problem is a lot of folks come in, and it takes a little bit of planning, right? You can't just willy-nilly come into the thing at the last minute and say, okay, let's go tax-free. You really want to have a little bit of planning. One of the some of the tough conversations we have are after a person has sold a business, and it's like, okay, now get me a tax deduction. Nate, you ever had that conversation?
Yeah.
Me too.
Or Mike,
The reverse engineered tax plan.
Which is usually not effective.
No.
do you think? Or Mike, hey, here's my taxes from last year. Can you save me some taxes?
I already did this. Can we undo it? No, we can't. Can't undo that.
So moving off the technical and just going to kind of a final anecdotal, observational thing when it comes to retirement is the win. How often are you seeing folks make the decision to pull the trigger on retirement and then want to kind of unwind that and go back to work or do part-time work or something like that?
Boy, two parts to that. That's great. And the first part is, when are you going to retire? So having a plan for that is a really good idea, and that's something that we offer a preliminary plan free of charge. You can assetsandincome.com. You can find us anytime, and we'll help you at least ballpark it, right? And then we come to you, the expert team, to make it real for all of our clients. But if the second part of that is if you do it and you want to undo it, then we help you there too. But the bigger deal there is actually not that common. I think what really happens is that people get bored. A lot of men and women who've been working their whole lives want to be doing something every day, and they finally get sick of their job and they're ready to quit, and they're thinking, I want out of this, I don't want that, I don't want that, I don't want that, but they're not thinking about what they want to go to and what they do want and how they're going to spend their days. And so they start something new, and it might be something that doesn't pay them very much, or it might not pay them at all. It might be all sorts of charitable jobs or work on the course or the club or the place where they love to be all day, and they're just having a really good time. And so they restart a new career, and maybe they start a new business in retirement, and those are really fun to work with, because if you can get yourself some tax deductions like we just talked about by starting a business where maybe you don't make a whole lot of money, it can be a really fun retirement.
But you say you're not seeing that very often, or
I can. It's hard because I just thought about three plans. Three folks I talked to today in very different situations. And the first is that situation where he's retiring from a job and wanted to know with absolute certainty that he could live a modest lifestyle and go make money if he wants to. And that person's well below the Social Security age. And certainly in his plan, he's got a long life expectancy, very healthy Coloradoan. It would behoove him to wait until age 70 to get the maximum Social Security he could, because he's retiring at a young age, and we're going to deplete, if not, spend down a little bit of some of those retirement accounts. So in that situation, go for it, and then figure out what you want to do. It's a great idea. You can always go back to work. He's a young dude. Tomorrow is a very different situation where the person's probably worked too hard, already and kind of had a health issue and got real. And he and his wife said, we can't do this forever. Let's put together the real plan, and maybe they accumulated more than they needed, but they just felt a lot of nervousness. And so they wanted to accumulate more than enough assets to be 100% sure that they could retire. Well, he's now looking at a plan where he's going to donate a lot of money to charity if he wants to. And so his church is going to be really glad that he worked really hard. And but the rest of us would just say, wow, you didn't need to work those extra years. Those extra dollars you saved might have cost you a few years of life.
All the more reason to kind of engage in the planning process as soon as possible, so you kind of know. I don't want to necessarily say pace yourself, but you can moderate your investment in your career, your building your business, whatever the case may be, so that it fits what you want on the backside.
Yeah, and the rest of your life, right?
Yeah.
I mean, it's a balancing act, right? And so you align your money with your goals and your values and your relationships during the whole process, not just at the end or even at the beginning, but all the big middle. And like one of the things you were talking about with the estate planning too, at the end of it, so that it goes to where you want it to go, and to the people who you love and the causes you're passionate about.
Well, always, as usual, there's more to the simple question of retirement income than just simply a mathematical formula. There's a lot of things that go into this, and we've hit on a lot of those. Thank you, Karl and Mike, for your insight. I'm sure we can build on this conversation and bring in other topics that will be helpful down the road as well. So. But we've come to the end of our episode and our time together today, so really appreciate it. Make a beautiful day.
Beautiful day, my friend.
Thank you very much.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.